morning, Spirit Airlines has filed for bankruptcy.
It's been a tough year for Spirit Airlines.
About its future to stay in business. Second in a year.
It has become clear that there is much more work to be done.
Hello everyone, we are from Group 7 of Financial Reporting Analysis class of Faculty of Economics and Business, University of Indonesia. Today, we will be presenting our analysis of financial, non-financial, and multinational operations of Spirit Airlines under the guidance of our lecturer, Ma'am Elvia Rosantina. But first of all, let me introduce our group member first. My name is Anisya Fahrani.
Greetings, my name is Nazwa Dienova.
And my name is Kayla Keisha Azzahra.
So, our title for today's presentation is Assessing Financial Reporting Quality of Spirit Airlines. What is Spirit Airlines? Spirit Airlines is one of the most prominent ultra-low-cost carrier in the US with value proposition, high efficiency, and low-cost model. So what happened to Spirit Airlines? The main issue here is the initiated bankruptcy Chapter 11 of Spirit Airlines in November 2024, then emerged and do the restructuring to reduce its debt, and also they lay off around 1,800 flight attendants in March 2025, but followed by the second filling in August 2024. So here's the major timeline below about what happened to Spirit Airlines. In November 2024, they filed bankruptcy Chapter 11, and then shareholders give $350 million to support their restructuring process. March until August 2025, they emerged from their first bankruptcy, and they did restructuring until August 2025. They filed the second bankruptcy again. So, what drove Spirit Airlines to the bankruptcy? As we can see in the diagram below, Spirit Airlines has downfall for their net income in 2020 during to the COVID, and this is mostly due to the rise of the cost, and this impact too difficult for Spirit since they built in the low cost model. So, and the next is we will analyze what happened to Spirit during the bankruptcy filings.
We begin by introducing the quality spectrum of financial reporting. This slide presents the theory we adopted from Robinson's framework. Therefore, we will now move on to the application of this theoretical model. And the slide still focus on the theory. Next. Think of financial reporting quality like the condition of a house. From the outside, the structure may look solid, compliant with building standards, and even equipped with all the necessary documents. That is where Spirit Airlines stands in 2024. Its financial statements are fully prepared under US GAAP, audited, and even provided decision-useful information, placing the company at the level 2 of the quality spectrum. However, when we look inside, the foundation tells us a different story. Despite compliant reporting, Spirit earnings are not sustainable. The company has recorded substantial net losses in 2020, supported more by debt restructuring and equity injections than by profits from core operations. This means the reporting quality is acceptable, but the earnings quality remains weak. One key concern also lies in cash flows. Spirit's operating inflows have consistently been insufficient to cover capital expenditures, debt servicing, and fleet renewal. This gap indicates that core operations do not generate enough cash to sustain the business without reliance on external financing. It is also important to note that Spirit Airlines received an unmodified audit opinion. The auditors at Ernst & Young concluded that the financial statements are presented fairly.
Okay, from the sustainability side, we classify Spirit in the third level of spectrum because Spirit explicitly says that the report is being prepared with the reference to GRI and SASB. But however, if we see the report, they're mainly just disclose about their past performance, so there are no reduction targets, no detailed plans, scope 2 and 3 are barely covered, and also they have no external assurance. So nobody independent checks whether the ESG data and narrative are complete and also balanced. Maybe I want to add, when we look for more recent evidence, there is no Spirit sustainability report after 2022, so we have to rely on an external rater. For example, we have here is Ditch Carbon. The latest climate score for Spirit is only 10 out of 100, which is very low compared to their competitor.
Next, let's talk about critical common size analysis. We look at the revenue structure using vertical common size analysis. The results show that Spirit's revenue is highly concentrated in passenger revenue, which consistently contributes around 98% of total revenue at that time. The remaining portion, classified as other revenue, mainly consists of ancillary services such as baggage fees, seat selection, priority boarding, and flight food and beverages, as well as fees for flight change or even cancellations. Even as this category expands, it does not meaningfully shift the story. Spirit revenue remains overwhelmingly passenger-driven. Based on our analysis, the slide tells three connected and major stories. First, if you look at the red box, operating costs in 2024 surged to 122% of revenue, meaning Spirit was spending more than it earned from every dollar of sales. Second, focusing on the green boxes, the cost structures shift over time. In 2022 and 2023, fuel dominated expense, but by 2024, the pressure moved towards salaries and even aircraft rent. Finally, the orange box highlighted an exceptional event. In 2024, Spirit recorded special charges and reorganization expense, costs that did not exist in prior years.
From the vertical common size balance sheet, the 2024 structure tells us one story. So Spirit is under liquidity pressure and increasingly financed through leases and restructuring debt. And on asset, the improvement we see in 2024 is not real operational strength. It is largely driven by aircraft being reclassified as asset held for sale. So basically, Spirit is saying we need cash, so we're preparing to sell part of the fleet. So that's a short-term liquidity move. And at the same time, the assets mix shows a clear model shift to less own aircraft and more ROU assets. So instead of owning the fleet, Spirit increasingly operates through leasing. So that's why the balance sheet looks lighter in own asset, but the economics become lease heavy. And on liabilities, the debt looks smaller, mainly because part of it's now being reclassified into a liability subject to compromise under Chapter 11. So it's not gone, it's just being renegotiated. And finally, the equity turns negative as repeated loss push retained earnings into a deficit. Once equity is negative, liabilities would exceed asset on a book basis. So the implication is clear that Spirit has been funding itself through obligation rather than profits. And in Chapter 11 bankruptcy, that typically means that creditors become more important than existing shareholders.
So the first one is operating activity of vertical common size. There's three accounts that quite different from the year before. That is fixed asset impairment change. This is due to related to the accelerated retirement of few of their aircraft. And the second one is the gain of disposal of assets. So Spirit Islands in this year, they sold lots of aircrafts and other airframe and etc. And also the last one is deferred heavy maintenance, where their major maintenance costs and amortization down to, so it's reflecting their effort to maintain short-term liquidity. The second one is investing activities, where there is still account that is quite different from before, which is pre-delivery deposit refunds. It costs 3% to year 2024. So it's mostly because they're demonstrating the company's success in recovering their liquidity. And the second one is purchase of property equipment. So in 2023 to 2024, they're buy a couple of equipment because it's profit from the asset sales that reach 2%. And the third one is financing activities, where they mostly there's account process from the IP financing that increased in 2024 for $300,000, and it came from a long-term debt issuance in Chapter 11 of their own bankruptcy.
If vertical analysis shows us the snapshot, horizontal analysis will show us the journey. Next. This slide tells a clear 2-year story. In 2023, Spirit revenue grew by about 6%, mainly supported by passenger demand and a sharp increase in other revenues, highlighted in the blue box. However, the red box in 2024 marks a turning point. Total revenue fell by more than 8% as passenger revenue dropped sharply. Even though other revenues continue to grow, this shows that Spirit's heavy dependence on passenger revenue. If the previous slides show pressure on the revenue side, this one explains why the losses deepen. Looking at the orange highlighted area, we see a clear structural shift in costs between 2022 and 2024. Spirit expense moved away from variable costs toward fixed obligations.
Now moving to the balance sheet. So what changed from 2022 to 2024? So on the asset side, the biggest movement is around the fleet and liquidity. So Spirit's cash position is already weak. And in 2024, they start creating the liquidity by shifting the aircraft out of own flight equipment, either reclassifying them as asset held for sale. But Spirit still needs aircraft capacity to operate, so the replacement comes from leasing. That's why we see the balance sheet shifting towards the ROU asset. And on the liability side, the restructuring becomes visible in the classification. Some long-term debt appears to fall, but the real story is that it get moved to the liability subject to compromise, meaning that it's now being renegotiated under the Chapter 11 bankruptcy. And at the same time, lease liabilities grows as Spirit signs more leases and sells and leaseback arrangement. And the final change is equity. So the accumulated losses push retained earnings into a deficit. So equity flips negative. So horizontally, the balance sheet is telling us that 2024 is not a normal year of fluctuation. It's a year of restructuring mechanics, like there's asset monetization, reclassification of debt, and a shift toward lease-based operations.
So the next one is horizontal common size analysis of operating cash flow Spirit Airlines, where there's a account that most significant, the difference between years, that is fixed asset impairment changes. This is because Spirit Airlines is no longer, the impairment is already written off by their non-asset activities, and also there's a loss on disposal asset. It's due to there's a gain on disposal asset in 2024. There is due to they selling their assets because of the restructuring process, and there's deposits and other assets. Also the accounts payable. And the next one is investing activities. In 2023, there increased until hundreds of thousands. This is because reflecting their large non-routine projects. And the next one is financing activities. There's a process from the IP financing, like I said before. It is due to their bankruptcy in 2024. And then there's a reimbursement for asset under constructions for others, fell by 100%, while debt and financial costs jump until 300%.
So far, we've seen what changed. Trend analysis helps us understand where Spirit has been heading over time. For the trend analysis, we set 2022 as the base year at 100% and apply a net revenue-based approach. This slide shows the overall trend from 2022 to 2024, where revenue failed to keep pace with rising operating expense. If we focus on the orange box, we can see the period where the gap between revenue and operating expense is the widest.
Okay, now for the balance sheet trend, this chart tells a very simple story. So if we look at the blue bars, which is asset, from 2022 to 2024, the total assets may stay almost flat. So Spirit isn't really growing its balance sheet, so it's mostly just reshuffling. And now the red bars, which is liability, it keeps rising year by year. So it reflects a heavier long-term obligation, especially lease commitment and restructuring related debt once Spirit entered the Chapter 11 bankruptcy. And then the last one is the yellow bars, which is equity. So as we can see, it shrinks sharply, enters negative in 2024 because of the repeated loss. So it wiped out the retained earnings. And this chart exactly shows us the pattern of a company under severe financial pressure. And it explains why Spirit ends up in Chapter 11 restructuring.
And then there's a trend analysis of cash flow. So as a whole, the performance of operating activities in decline significantly. And then the investment cash turning positive. And the last one is financing cost is fluctuated years to years.
Okay, now we move to the financial ratios of Spirit Airlines. The first one that we're going to look at is the activity ratios. So a lot of Spirit ratios here looks very high, but that's mostly because of the denominators are decreasing, like working capital, and the equity becomes very small. So the turnover numbers is jumping high. So it doesn't mean Spirit is suddenly more efficient, because it means that the business is being run with a very thin liquidity and capital buffers, which is actually very risky. And also at the same time, the asset base ratios are moving in the opposite direction. So they are going down because the total assets stay heavy, but the revenue falls. So each dollar of asset is generating less sales than before. And this tells us that Spirit's balance sheet is overbuilt and also underused, which matches the need to sell their aircraft and shift more into the leasing. And maybe the receivable turnover and DSO here is the only metric that still look reasonable because the cash comes in very quickly, but still they are not strong enough to offset the bigger picture. And overall, the activity ratios confirm that Spirit is operating with very thin liquidity, weak asset productivity, and a fragile capital structure.
Next, we look at liquidity by comparing Spirit Airlines with its closest peer, Frontier. Spirit's current ratio improved about 1 in 2024, indicating a temporary ability to cover short-term obligations, while Frontier remained below that level. However, when we move to the quick and cash ratios, Spirit positions weakens. The solvency ratio highlights structural distress at Spirit. Negative equity inflates leverage. Debt remains high relative to assets, and operating income cannot cover interest costs, clearly distinguishing Spirit financial risk profile from Frontier.
So the next one is profitability ratio of Spirit Airlines compared to Frontier Airlines. As we can see in the ratio of Spirit Airlines in 2023 until 2024, it all remained negative, and there's no increasing at any ratio. There's indicating rising costs, declining efficiency, and increasing financial pressure. In contrast, Frontier Airlines demonstrated improving profitability, with margins turning positive and returns on asset and capital increasing. That is reflecting better cost control, stronger operation performance, and their financial recovery. The next one is valuation ratio. As we can see, Spirit Airlines remains under the significant financial distress, as reflected by worsening EPF, negative PE, negative perceived book value in 2024. Meanwhile, Frontier Airlines shows improving valuation metrics, including positive PE and EPS, suggesting renewed profitability and stronger market confidence, making Frontier relative more attractive in valuation perspective than Spirit Airlines.
Okay, now we're going to talk about the sustainability aspect of Spirit. So the company basically tries to show that they cover the full ESG pictures because they talk about the environmental efficiency through fleet modernization and lower fuel burn. And they also highlight the social and community programs. They also position the workforce initiative around safety, well-being, and also inclusion. And the last one, they emphasize the governance and maybe things like oversight, ethics, safety culture, and also data protection. But now the key issue is what happens after that. So there is no sustainability report for 2022 to 2024. And because of that, we have to fully rely on the external signals, and those are still not strong. For example, we have Ditch Carbon here that gives Spirit a climate score of only 10 out of 100, and other ESG indicators flag high risk. So the takeaway is the sustainability narrative exists, but the reporting lacks continuity and forward-looking commitment. And also it aligns with our earlier conclusion that Spirit shifted into short-term survival mode during their financial distress. So the long-term sustainability becomes less visible and also less prioritized.
This presentation is structured into 8 parts. We begin with a brief introduction. While Spirit Airlines is often perceived as a US-based carrier, we conduct a little more research, and it shows that its operations extend well beyond national borders, serving 78 destinations across 18 countries. Spirit operates in a multinational setting that introduces complexity in currency exposure, regulations, and even cost management. We move on to foreign transactions. We can think of currency like language. A company may operate in many countries and use many currencies, but it still chooses one main language to report its financial performance. For Spirit Airlines, this is reflected in 2 types of currency: presentation currency, functional currency, and even local currency. Now that we understand the different language Spirit used, the next question is, what happens when those currencies move? This brings us to the topic of foreign exchange risk. Here's a simple example. A passenger books a flight from Colombia and pays in Colombian pesos. Between the booking date and the settlement date, the exchange rate may change. If the peso strengthens, Spirit records a foreign exchange gain, leading to a higher USD revenue and a temporarily improved margins. However, if the peso weakens, Spirit records a foreign exchange loss, reducing reported revenue and operating margins. If earlier we saw how exchange rate movements create gains and losses, the next question is whether Spirit operates in countries where currency rates become extreme. But because the thresholds are not met, Spirit is not required to apply hyperinflation accounting.
Okay, now for the foreign currency translation risk, the key message here is that Spirit's translation exposure appears to be limited. So Spirit does have foreign entities such as Cayman subsidiaries, but these entities are mainly just financing and legal SPVs. For example, they support the issuance of secured notes and hold certain structures like IP or loyalty-related arrangement. So they are not operating airlines with significant local currency balance sheets. So there is no large local payroll, no major local working capital, and no big operational assets. So economically, what they handle is still largely USD linked. That's why when we look at Spirit's consolidated statement, we don't see a foreign currency translation adjustment in OCI. So the takeaway is the FX translation is not a major factor in Spirit's reported performance. So their multinational setup is just mainly just legal and financing related, not the kind of foreign operating structure that creates a large amount of translation swings.
Next on, we will discuss about geographic revenue disclosure of Spirit Airlines. To start, Spirit is not highly international in scale, but it is international enough for currency and regulatory risk to matter, as reflected in its divided geographic revenue disclosure in their annual report.
Okay, so for the multinational operation, there's effective tax rate of Spirit Islands. So, in Spirit, foreign tax should appear in the current foreign tax expense sections, but because the foreign income contributions are only under 4%, so the impact of the effective tax rate is immaterial and appears in other category in the tax rate reconciliations. And the change in Spirit effective tax rate is mainly due to their domestic account adjustments, such as valuation allowance for their operating losses, rather than differences for foreign tax, as its international activity are small proportion.
Next, we're going to talk about the international exposure in procurement. So even as low-cost carrier, Spirit is a major fuel consumer that makes them place 7 in the 10 airlines that use the most jet fuel in America. And what makes this international exposure is that fuel pricing is not purely domestic. So Spirit's international procurement is largely indexed to US Gulf Coast jet fuel prices. So the disruption in that region, like refinery issues, hurricanes, or other supply shocks, can quickly affect the price they pay. But the final fuel cost is also shaped by the local airport and country condition. Even if the benchmark is Gulf Coast jet fuel, the into-plane price at each airport can include local taxes and regulation, transportation costs, and also local supply dynamics. And one more important point, Spirit doesn't hedge fuel, so they haven't engaged in fuel derivative actively since 2015, which means they don't have a financial buffer to smooth fuel price volatility. So overall, Spirit's procurement exposure is highly sensitive to global energy markets and regional disruptions. And in a distress situation, that volatility directly hits the operating performance.
Okay, so the next one, there is a climate-related risk in multinational operation of Spirit Islands. So we can see the diagram below that the climate risk impact, it's led to greater Spirit obligation in CORSIA program. So overall, the extreme weather increases operating costs, disrupts schedules, and magnifies the company's environmental impact and results in additional costs to be paid in CORSIA. And CORSIA is a carbon offset and reduction scheme for international aviation. The next one is there is a climate change. So as a whole, in 2024, Spirit Islands maintenance costs will decrease due to reduction in heavy maintenance, fleet grounding due to Pratt and Whitney GTF engine issues. There's a fewer flight hours, so there's less wear and tear. And this last one is a reduction in aircraft usage, resulting in a decrease of routine maintenance requirements.
If we had to put real money to work today, our team would avoid Spirit as an equity investment, except for very high-risk, special situation investors, and would prefer Frontier as the relatively safer recoupling ULCC, whilst acknowledging that both operate in a volatile, high-risk industry.